Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
This is Paul Tyler, and welcome to another episode of That Annuity Show. Bruno, welcome.
Thank you. Great to be here. And excited about our guest.
Tisa, glad you got your... Yeah, Tisa, good to see you.
Good to see you. Good morning.
Yeah, we've been busy on a lot of fronts the last few weeks, haven't we? And Ramsey, it looks like I think you're broadcasting from an undisclosed location today.
Indeed.
Correct?
It looks kind of like a wine cellar, doesn't it? But yeah, it's not. Very happy to be here and really excited to welcome Laurence Black and the Index Standard. The Index Standard has been our lead sponsor for the better part of the last year, so we're really excited to have them on. They're doing a lot of very interesting things in helping the index community unpack the best way to allocate indices and the best way to understand their role in a broader portfolio. So with that, Laurence, I want to start out with you, and you also have a special guest, a new addition to your team you're going to want to introduce as well, so I'll pass it on to you for that.
Hey, good morning. It's great to join you. I'm delighted to introduce Branislav Nikolic, who's just joined us from Canix. He was head of research, and he was there for about almost a decade. And at the Index Standard, we've got a lot of index expertise, and it's great to kind of expand our capabilities with Branislav's in-depth insurance knowledge.
Branislav, welcome. Yeah.
Thank you. You wanted to be here.
Yeah. Yeah, tell us just a little bit about your backstory. How did you get into the annuity space?
So my story with annuities was completely haphazard. So all the way through school, I thought I would end up on a trading desk somewhere, be a proper quant, and I had enormous luck to meet Moshe Milevsky extremely early in my career, and started working for his startup. Later joined Canix, which is again an industry leader on data analytics for annuities. Spent good almost 10 years there, leading research and really helping Canix build their capabilities in all sorts of annuities in terms of platforms for exchanges. That's how I met Laurence and Jay, and I really saw the two missions extremely complementary. And I always saw the index as a fuel to the annuity, and I always was saying that it's important to have these two things evaluated together. So we started talking, and I'm extremely happy to have joined the team and to be side by side with Laurence and Jay.
Yeah, and Laurence, it's actually we saw each other in person. It was tremendous.
Indeed.
I made the very last minute decision to attend NAFA this year, and AFA for those of you who want to look this up. Had their conference in California, showed up, and Laurence, you were on a great platform talking about kind of the landscape of product design and indices. Maybe for our audience, you could just sort of talk to us a little bit more about the problem you're solving and, what's taking place in the market today.
Sure. Thanks, Paul, because, a lot is happening. So let me just sort of give everyone a little bit of background about what we do. So at the Index Standard, we all know there's so much complexity in this market with the indices and the payoffs. So what we do at the Index Standard, which we're really trying to simplify, decode, and demystify all this complexity. And we do it in a couple of ways. We've got a lot of research that we help people, giving them insights as to what products and indices to select. We also actually rate and evaluate every single index used in the insurance space. We give it a platinum, gold, silver, bronze rating. And then we actually have some forward-looking forecasts to help people think about the future, because we all know the future is going to be different. So we have some forecasts. And then we've actually, on the back of these forecasts, we've actually launched some model allocations. So allocating to an annuity can be really tough with sort of 15 crediting lines. So we've actually built a tool to help people with that tough selection. Now, I just want to give you some background about the index industry. So one interesting fact, it's actually almost $1 trillion industry that no one knows about. So I call it like a niche market that's $1 trillion. So, we see in the U.S. insurance space, there's probably is the bulk of risk control indices, probably about half of that. But actually, risk control indices are used in Germany and in Switzerland. They're actually used in the insurance space. They use risk control indices in mutual funds. And then another big portion is structured products. We estimate there's probably 250 billion in structured products that actually are linked to these risk control indices. And then actually you have this sort of bank market where they're doing direct transactions with big institutions. That's probably another 200 billion. So in total, we think it's around about $1 trillion market.
So that's incredible. I mean, one of the things though that has been interesting about the market is it's been characterized by a lot more choice, and there's a lot of value in additional choice. But with those choices becomes many more complicated decisions.
Yeah.
And so I guess a question that I have for you is like, so what are your various target audiences? I can certainly see why retail consumers would want to be able to decode all the choices, but I would imagine that institutions are almost similarly challenged. So what are your target audiences for your product lines?
Yeah. So we're actually kind of targeting that whole gamut. We want to help organizations with the selection and due diligence of these indices. We want to help organizations who are selling them, that they can use our reports to kind of position them. And then the end consumer, I mean, the main reason I'm actually here and doing this is I want Mr. and Mrs. Smith who are buying these policies to do better, right? By choosing better indices and building diverse portfolios. And let me just make one quick comment about the indices, because, I think we hear a lot about the complexity, but also on the sort of flip side is actually it's really wonderful, because what we're now seeing is a lot of the users are actually getting access to techniques that were only used by hedge funds or big pension funds. I can give you an example. There's a technique called mean variance optimization. So just a fancy way of saying, give me the best allocation to target a certain level of risk. That was kind of, actually Harry Markowitz came up with that technique in the late 50s. He won a Nobel Prize for it. But up until a couple of years ago, you only had big pension funds and big hedge funds were using that. But now, amazingly, that technique is in indices and we can all access that. So that's actually a really wonderful innovation that all of us can use that to do better.
That's wonderful. And can you talk a little bit more about those actual metrics and in practice? What type of metrics that you use to rate those? I mean, you list plenty in terms of calculating and measuring those, like capital at risk metrics, efficiency metrics, return metrics. What are those metrics, and what do they mean for people who ultimately use them?
Yeah, hey, great question, Bruno. So we actually look at about 35 metrics, and I'm going to loosely break them down into three groups. So the first group is we really want to look at the complexity of each index and how it's designed and the availability of the rules and who's calculating that. The key thing is really that complexity. We'll look at the diversification. We'll look and see if the rules are available. We'll look and see if there's an independent index calculation agent. And we like to see those things. And by the way, what we prefer to see when we're looking at an index is simpler is better than an index with lots of signals. Second category is what you touched on. We'll look at a lot of metrics such as returns and volatility. But there we want to kind of go under the hood, and we look at something called VAR, which is VAR, but it's just simply a metric that tells you how much you can possibly lose.
What does that spell out to, Laurence? For those in our audience who don't know what that spells out to.
No, we're going to keep it simple. We just look under the hood and we kind of figure out the max that you could lose.
All right.
We also look at, the number of months that the index has positive or negative returns. We look at another technical measure that says, have you got a propensity for positive returns? We also look at large, big outliers as well to see if you've got any positive or large negative outliers. Again, that tells us a lot. And then the final categories, we actually look forward and we actually bring in some of our forecasts to try and also have a forward-looking measure. So we score each index out of 100, and then we mark it on a bell-shaped curve when we allocate platinum, gold, silver, bronze, and then we also have watch and neutral as our worst categories.
So, Laurence, if I'm an advisor selling one of our own company's products to TISA, and I've got the materials in front of my at the table, because the virtual table, I have a lot of personal risk at stake here, right? I could recommend indices that crater in the next 2 years. I could come up with recommendations that are all kind of bunched up in a couple. I may think I've diversified the actual indices when in fact I've put all of her retirement into sort of one sector. Sometimes advisors simply default to saying, look, TISA, just pick 3 or 4 of these and let's divide by that number and put them in these indices. Oh, and by the way, we now have best interest standards, coming down the pike. What does that process look like? Do I spend more time with her, Laurence? Do I have better tools? Do I go in with sort of preset recommendations? What does that process look like 2 or 3 years from now?
That's great. Let me answer that in 2 parts, and I would love to bring in Branislav to answer the second part here. So, let me give you a couple thoughts. Firstly, I think the future is going to be different from the past. So always looking at these past historical returns is probably not going to be optimal. And let me give you some simple examples, right? Firstly, the last decade we had low inflation, low interest rates, no tech tailwinds, and globalization. And it was a great environment for large cap tech. Going forward, I think everyone recognizes, right, we see higher inflation, we see higher rates, we see deglobalization, and this tech is being regulated. Amazon, beg your pardon, a recent big merger just got blocked between Microsoft and Activision Blizzard. So that, the world is going to be different going forward. So, I think there are a lot of people who are just allocating, 100% to a benchmark index. So we want to encourage people to look forward. So the way we do that at the Index Standard, we actually take the wisdom of Wall Street. So we actually go and collect about 35 asset managers and banks, their 10-year forward-looking returns. And then what we do is we actually apply these actual expected returns to each index. And then we're able to produce a forward-looking forecast for each index. So now I want to hand over to Branislav, who's going to talk about one of our latest innovations and what we've been doing around kind of making that more useful for an FIA. Over to you, Branislav.
Thank you, Laurence. So again, the key for me and one thing that I'm extremely passionate about is how does this, to your point, Paul, get sold, or how is this presented over a virtual or actual kitchen table, right? Because again, who are the buyers of annuities? Pre-retirees or early retirees? And you have 2 motives. One is guaranteed income for life. One is the accumulation with a protected downside. Either or, you're looking for your index more often than not to provide basis of growth. If you're looking on the accumulation side, that's obvious. If you're looking on the income side, you have more and more products coming in with the ability to harvest some of that index growth and translate it into cost of living adjustment on your income going forward. One way or the other, you have to understand the annuity, which I like to think of as an engine or a car. And you have to think of an index, which I like to think of as fuel. You have like perfect grade fuel, you put in a bad engine, it doesn't go. You have a perfect car, put a basic gasoline in it, doesn't go either. Like it starts to clink. You need the best combination. And this is where I believe that looking into forecasts, first of all, coming from as Laurence was mentioning, wisdom of Wall Street transformed into how these indices will do going forward, putting that through the annuities to achieve something that we call it in Index Standard the net forecast yield, basically trying to see what would the annuity with a given crediting strategy on a given index provide over the next 10 years. And then on top of that, now look into all of these options and see which 2, 3, 5 options will give you the highest expected return going forward. So again, thinking about the design of the engine, whether it's a strategy, whether it's a parameters, are you paying a fee for it or not? What type of index are you putting through it? If it's a benchmark, you're usually getting a fraction of a return. If it's a volatility control, you get a multiple. Now, let's say that you get 10% return on a benchmark index and you get half of it. Okay, 10%. Are we going to get 10% next year or the year after? I don't know. But if you get a volatility control index and you get 2, 3 times of it, even if it returns 1, 2, 3%, you're already doing much better. All of this has to be taken into context. The other one is that probably the truth lies somewhere in between. Looking into the history and seeing high returns, are you going to see these going forward? No. Are you going to see exactly what's happening in the forecasts? Probably not. But I think these two are perfect basis for a conversation. One for legal reasons, you got to do it because that's how you sell the annuity. And the other one is to basically show that you have kind of done some thinking outside of the box in terms of due diligence and what could happen. And again, use this as a cheat sheet to show how well you understand the whole car plus the fuel on a racetrack.
So a quick question here. So this makes a lot of sense, right? For a variety of reasons. And the question is has anybody done this before? Has there been primarily a focus on history and in particular back testing?
Yeah. I think there's been such a focus on the industry in back testing and listen, it has a place, but what we like to say is take the back test and take the forecast and sort of think about them using together. Let me give you a common sense example that we've been thinking about. So right now, some of the large cap tech indices have a last 10 years of historical returns of 16%. So let's kind of apply common logic and let's take Apple. Apple's the largest constituent of a lot of big tech indices. So Apple, the market cap right now is about 2.4 trillion. So if I take that 2.4 trillion and I'm going to compound it at 16%, like many is shown in the software illustrations, actually that means in 10 years' time, Apple's going to have a market cap of $10 trillion. Now, maybe that's going to happen, but let me give you some context. The German GDP is 3.8 trillion. So yeah, it might happen, right? But that's why we want to encourage people to be diverse because like I was just saying, I think it's going to be a decade of discomfort, right? We've seen the end of globalization. It's going to be difficult. So I think you want to be diversified, right? Look at emerging markets. Their historical returns for the last 10 years are kind of about zero. So maybe they're going to do better, right? You want to put a little bit of money in there. Right now, everyone's so bearish about Europe, but maybe you want to sprinkle a little bit in there too. So we just think being diversified is really important. And with our innovation of helping people to choose across complicated crediting strategies that Branislav just outlined, we take that complicated choice between, let's say, choosing 50% of a benchmark index or 200% in a risk control index. We just make that into an apples to apples conversation where we can say, maybe you're going to get 5 here and maybe you're going to get 8 here. So build a diversified portfolio.
One thing, Laurence, that I would like to add, again, Laurence being an expert to what I call fuel and indices. Again, it's great insight. But again, looking into just these strategies that you get in these annuities. You have strategies that are built to harvest the sharp growth. You have strategies that give you capped returns. So basically, you're looking for a positive. You have some that are looking for just positive return, and then you're good. You have those that are looking for a consistently positive return without any volatility in them. How to know? Again, you can have your view of the market, you can have your outlook. But how exactly you know where to put 100% of your money? You don't have to know. That's why it's good to diversify. That's why it's good to diversify across strategies, across indices, and basically get all of these tools available to you working for the end user, which is the most important piece.
Yeah, this is a key element of this problem.
I was going to say a key element of this is that figuring out how diversified you are is not a simple problem, right? So it's not just Joe the advisor saying I'd like some Europe, I'd like some U.S. exposure, et cetera, because there are correlations across those various assets as well. So I think that folks in the audience that would consider using a platform like this, it's important to understand that it's you can't really do it properly unless you have a pretty sophisticated engine under the hood to be able to capture not just the obvious sources of diversification, but also the less obvious places where you may be not as diversified as you think.
Yeah, that's a great point. And, we do work with Canex to get some of the data, and Branislav joined us from them. And actually on our staff, we've got mostly quants. We have Jay Watson, who's one of our other partners. He's got a quant background. We've got Trent McKinnon, who also has a master's in finance. Jay has a PhD, and Branislav has a master's in working on his PhD. So I've only got an MBA. So I feel, these guys are the smart guys that we have here. And yeah, it's very complicated, and we spend a lot of time modeling that out. But the key thing is we want to make it simple for people and present an apples-to-apples comparison. We want to help people and boil it down just to what do you need to know. Here's the apples-to-apples comparison, and here's a way to allocate. Because this industry is too complicated.
And Laurence, one thing that you touched on, and I think it's important, and Ramsey asked this, has anyone done any of this before? And I think that we are trying basically to raise the tide. I think that this industry requires all the parties to collaborate. And I think this is where we get, again, great data and some of the calculations from Canex. We have our index forecasts. We have our model allocations. We are willing to work with others because at the end of the day, I think this is a tide. And I think that shift has to happen. It's important for it to happen. Again, for the end user, it's the most important that this shit happens. And legal point of view will catch up. The illustrations, their legal requirements, they're an important part of it, but they don't tell a full story. And we are trying to augment that story that makes it more palatable and easier to have as a conversation today. But 2 years from now, if things don't turn out like what was shown in the illustration, that's the most important bit.
Yeah, let me talk a little bit more about what diversity actually means. I like the fact, Laurence, you say we encourage people to look at back-tested returns against forecasted returns. There's also a time factor, right? Because if you think about possible outcomes, you may have one fund that appears to have highest likelihood or indice of great returns, but there are also some outliers, right? There's some cases where, wow, Tisa could get zero. She might get a 20% return. She might get a zero. Now, if she's about to retire 2 years from now and start to pull money out, how do I factor in the possibility that there might be a zero here? Yeah,
right. Wow, there's so much in what you've asked me that I'd love to talk about. So, great thought. So the first thing is, I think everyone really expects benchmark indices to give positive returns, right? The last 10 years, except of this year, we've just seen positive returns. So people have been treated, and we all have this recency bias. Now, this year, we're probably going to see a negative on many of the major benchmarks. And, next year, if you look at some of the one-year forecasts that some of the investment banks put out, a couple of investment banks are calling for negative returns. So I think people are going to be shocked. So what you really want to do is find indices that yin and yang, that when, one is up, the other one's down and vice versa, right? So that's what you got to find, indices that yin and yang. And then you want to blend them in. Now, why is this important? Well, I got to tell you, I think the most important thing in finance that we all tend to forget is compounding. Compounding is the magic in finance, right? Just by eking out a little positive return each year, the next year you're compounding on a higher number. So if you can get your client even 2 or 3% versus a zero, that next year you're going to start at 103 on kind of compound that return. So compounding is the magic. That's what you want to do, is just get your clients a little positive return. You can build wealth like that.
Laurence, I would like to kind of add to that a bit, and I think this is an important one. So when you look into benchmark indices in the last 30 years, let's say, you would see that we had periods that would last 7 or 10 years, and then you have a correction. So there was no period of 20 years that you had high positive return. There was always something happening in the middle that would kind of take us back, and then you have like the star growth. You look at a history of those indices, you had periods in 30s, 40s, 50s, even 60s that they had like a constant 7% return. So if we can go back at a time, I think that our conversation today will be obsolete if you have an index returning 7% year over year. Here we're talking about people thinking of averages, but the sequence of returns matters a lot. And then that's what I think what Laurence is saying. I would try to kind of relate to the annuity folks a little bit different, is basically saying that if you have a 7 or 10 year annuity, are you better off getting solid returns 3, 5, or 7 out of 10 years, or you should get positive return in all 10 of them? And again, depending how these are used in the plan, if you're living off interest or that fixed credit, you want it every year, and you want to be able to plan. So I guess it really matters how you're putting this into the annuity as well. Another thing that became apparent as we were doing the research for the model allocation was that there are some strategies, when you look on a forecasted basis, they don't even beat the fixed rate. Again, fixed rate a year ago, we wouldn't be even talking about it. But today you have it at like 3, 4, 5%, and you have a strategies that have a forecasted 10-year yield or return less than that. Now that begs the question, why at all participate? Why don't get some of the security of the high fixed rates going forward and combine that with some other indices? Again, whether 5% will keep you up with inflation of 7, I don't think so, but I don't think inflation of 7 is going to be year after year. So a lot of things to unpack, and that's why I think that allocating across everything that's available within the annuity, looking into index diversification, strategy diversification, banking on historically high rates, I think there is a lot to consider.
Yeah, and actually, Branislav, there's also another complexity. People have the choice: should I choose a 1-year point-to-point, or a 2-year, or 3-year, or up to a 6-year, right? And that's another complexity that we look at and try and figure that out. So yeah, there's a lot going on in these products.
Lots going on, to say the least, and I think there's a lot of material in what to unpack, and what you just said in terms of decumulation, the sequence of return. And all that diversification. If we put all the pieces together, you mentioned that you're launching this the model allocation for FIAs. First of all, can you tell us a little bit of some of the timeline behind that, and what does that mean ultimately for the consumer, and how are they going to be able to use that special tool?
Thanks, Bruno. So we've been working on this for the last year. It's taken us some time to model out more than 3,000 crediting strategies and then figure out an allocation. So we're actually going to be launching in mid-January. We're starting to tell people, and in fact, we're grateful to be here on the podcast right now, and that's part of our mission to tell people. And then sort of through the course of December, we'll be letting a lot of our partners, insurance carriers know. And then mid to end of Jan, we'll be launching, formally going to market and telling everyone about it, making it available. We've already got 1 or 2 partners who've signed on, so we're excited because it helps our mission. We want to see people do better.
So I was recently in a conversation with sort of a fairly sort of sizable financial institution in the advisory space, I'll say, and they were trying to figure out different ways to incorporate more annuities into their platform. And one of the challenges was that increasingly the advisors were being asked less and less to make investment decisions, and they were more focused on relationship management. And so the implication of that is that the investment strategies, the asset allocation strategies, actually come from a centralized source, right? And the centralized sources need to rely on models that use a lot of data. And so if you think about use cases for what you're building here, Laurence and Branislav, is that you're bringing robust data where it didn't exist before, so that it can potentially be used at a sort of an entity level, if you will. I like to call it factory settings, right? At an entity level for larger financial institutions, so that at the end of the day, the advisor will be able to rely on something that's been fully vetted at an institutional level. But in order for all that to work, you have to have reliable data. And to your point earlier, it really didn't exist across the whole sort of spectrum of offerings until you guys launched this product. So, congrats.
Yeah, thank you. I'll make a remark and then see if Branislav has anything to add. One of the things we see, and having worked for a large financial institution in my prior life, one of the key things is everyone wants some kind of forecast, expected returns, expected volatility. What's the correlation? They need those to plug into their model. And in the annuity space, there's been nothing. Now, with what we do at the index standard, we're able to provide expected returns, expected volatility, and we know the correlation. So we can help fuel those discussions that these large institutions are having. We can provide the inputs. And I think my final observation is this, that I think if you was to use some of the expected returns we see, I think the annuities would get a bigger allocation than they have been, because they have no downside risk in the case of a FIA, a RILA, it's capped, and some of the expected returns might be 3, 4, 5, 6, very consistent. So I think they'd get a larger allocation, and that would surprise a lot of people. Branislav.
Yeah, I think there's like two levels of this conversation. One is, how do you incorporate this in a broader portfolio? And what Laurence mentioned, knowing what these could return and at what level of risk, I think would make advisors more comfortable. Again, we have a generation of advisors who grew up in a bull market, right? And would you ever consider an annuity a safe investment, a downside, when you never had to? Now I think we are getting to that realization that's going to start happening, and again, a lot of great tools available out there. A lot of parties providing phenomenal either end-to-end processes or optimal product allocations or simulators of how well you do, where you should locate your assets. The key is that no one knew how to project, big air quotes, the annuity going forward. And I think this is the important piece that we bring to the table. Again, something that is showing not only in the retail market, but more importantly now spilling over into the institutional market as well, that people are adopting these concepts at a DC pension plan level that really kind of add the validity to it, and it kind of adds to the conversation that if super conservative folks and legally aware are considering adding these into the mix, they had to be a good thing. So a lot is happening, and we love to be a part of that conversation for sure.
Yeah, no, I honestly think you could be the next morning star, right, in the FIA space. I don't know if that infringes on copyrights, but Laurence, that's what I call you. Tisa, you've been doing so much work with agents helping them sell digitally, tell a story, talk to consumers. What goes through your mind when you think about trying to explain something this complex on a website, in a brochure, in a video?
Yeah, I mean, when I think, Laurence, I heard you talk about, the Mr. and Mrs. Smith, so sort of the generic consumer or retiree out there thinking about planning and demystifying the idea of an annuity and the complexities of what we're talking about. How does your presentation or the educational tools you're offering, how does it break it down for them to kind of combat the emotional side of the decision, right? You've talked about the changing interest rates and inflation and all the things that are ahead and a lot of the unknowns that are ahead. How does the tool kind of speak to that emotional side of, I'll say fear, but at least sort of that uncertainty that's ahead, and that agent or advisor bringing them through those conversations?
I think in a couple ways. So firstly, what we do is for each index, we evaluate it. So we'll put a platinum, gold, and silver and so on, so that you can at a glance see what that index is doing. So it might be a little bit unfamiliar, but you get our sort of stamp of whether we think it's a robust and well-designed index. Now, the other thing we do is, we all know finance is complex and people love to use complicated language. So we actually have a copywriter on our staff. And we try and use straightforward and clear language. So I'll give you an example. The way we would describe a risk control index, we just say it cushions and it smooths. And then the final thing that we do is we have our forecasting reports. And we very clearly show here that is the last 10 years, maybe you got, let's say, 6%. And then here's how we apply the wisdom of Wall Street to that index. And maybe you're going to get 7, 8, or 9, or maybe you got 16 in historically, and we think you're going to get 4. But we have very clear bar charts. So we try and provide people with visual, simple language and easy to understand demonicas, gold, silver, platinum, and so on, to really help people when they're making those decisions.
Yeah, the gold, silver, platinum. That's those are the star reviews, right? It's really at a glance. Here's the top, middle, and maybe not so.
Yeah,
good.
Exactly.
Yeah.
Thank you.
I love it. Bruno, we're close to the top of the hour. I mean, what are your thoughts, questions, observations?
Well, number one, I think it's wonderful that we're going back, or that at least you guys are going back to some of the basics, some of the textbook concepts. I mean, we live in a world of headlines and, this is going on, this is going on. Just the fact that you're framing it, that you're actually putting it into a some sort of framework, some sort of boundaries, some sort of ratings, and in perspective with the rest of the economy, I think that adds significant value, and I think that's a very useful step for the industry.
Yeah,
thank you,
Ramsey. You want to bring us home?
Yeah, so I wholeheartedly agree. This is an area that's expanded dramatically, and again, the choices expanded much more quickly than the analytical framework behind it. And we live in an environment where the analytics are important. They're important for legal reasons. They're important for just helping people make the right decision. They're important for helping people feel comfortable with their decisions. And as I had mentioned before, I think it's going to be useful, certainly at the consumer level, at the advisor level, and I think very importantly at the institutional level, where the burdens of proof, if you will, are very high. I think that this is going to be very important, and it's something that gets asked about in a lot of meetings. So if you're talking to larger insurance companies, and this is something that comes up a lot. This has been an unanswered question. So I think this is a great initiative.
Yeah, and Laurence, you saw at NAFA on that discussion panel how much independent marketing organizations need this type of tool for their marketers and for their agents. So I think the timing couldn't be better. What's the best way for people to find out more about your product or reach out to you personally?
Sure. So our website has a lot of great information, and that's theindexstandard.com. And you can email us at info@theindexstandard.com. I'm also pretty active on LinkedIn. So is Branislav. Please follow us. We also have a LinkedIn at The Index Standard. Follow us. And we kind of put some of our insights there. And, of course, our newsletter as well with you guys.
Excellent. All right. Well, listen, thanks so much for joining us. We want to thank all our listeners. And please give us feedback, comments, and as long as they're good. Bruno, I actually had somebody comment on my audio editing skills and or lack thereof. So we welcome all, and listen, join us again next week for another episode of That Annuity Show. Thanks.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.